Hello and welcome to Portfolio Matters Weekly Update, Week 85. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end.
Well, thank you, Richard. So before we get going, a reminder, pub night. Well, pub night will be on Tuesday, the 27th of September. And after some reflection, I've decided we should go back to the Princess Louise because it's likely to be cold and we can be indoors. Let's hope it's still open. So news. Well, unless you've been living on another planet, you'll know the sad news that Queen Elizabeth has died and we have a new king, Charles III.
Are you going to join the queue?
I am going to join the queue, actually. Pip and I are going to go down very early tomorrow and queue all day.
Good for you.
Yeah.
Well done.
We're not Republicans on this channel, and we are saddened by the death of the Queen after many years of loyal service. But this is an economics and markets podcast. If you want wall-to-wall coverage, look elsewhere. Okay, news elsewhere. Well, there's lots going on. So Ukraine has made very successful counterattacks in eastern Ukraine and has captured quite large areas of the Donetsk. Now, what is going to happen next? We have a special section coming up on the conflict. Elsewhere, conflict has flared up between Armenia and Azerbaijan, and I also saw between Tajikistan and Kyrgyzstan. So there's a lot going on in the world at the moment. Now, the UK has announced the Energy Price Guarantee Scheme, and we have a section on that going through its economics. The big news of the week in the markets was US CPI number came out, and it was unexpectedly strong. Inflation in the US shows very little sign of peaking, and so that led to a very sharp fall in the S&P 500. And finally, the EU is seeking to raise 140 billion for a windfall tax on energy providers, primarily renewable energy providers and companies that don't burn fossil fuels. Essentially, they're going to put a cap in at 180 euros per megawatt hour and take all the profits above that. So this is the August CPI print, and after it, markets suddenly started to price in a strong possibility of 100 basis point hike in US interest rates next week. In Italy, there's an election next week, and this is the polls leading up to the election, which show that a far-right coalition is very likely to take around 60% of the seats, and they have historically been very anti.
There's also an interesting Sweden, the centre-right party in Sweden looks like it's going to become a significant force in the Swedish election. So I suspect that Europe is drifting to the right as a consequence of war, the failed migration policies, and economic stress.
Yeah. So the Eurozone faces problems on many fronts. In the UK, I thought this was interesting. Only 12% of Britons actually think Liz Truss is going to make a good prime minister. Richard, where do you stand on this chart?
Well, I have an open mind, and the reason I have an open mind is because I know she has been slated during the campaigning. But you do have to say that we need a little bit of out-of-the-box thinking to get ourselves sorted out. And whether you can do the right sort of out-of-the-box thinking remains to be seen. I am firmly convinced that the way to make this economy successful is to be a low tax economy. And we are a high tax economy, very high tax economy. And I think Rishi Sunak's comment that reducing taxes would increase inflation was frankly, a word beginning with B. And so I actually think the jury needs to be out for a while. And I'm giving her the benefit of the doubt. But that is very much a don't know, and I really hope for the best. But what's your view, Keith?
Well, I praise your open-mindedness about this, Richard. I frankly am with the red bar here. So far, she said nothing intelligent as far as I can see. We're, economically intelligent.
Well, my fear is that they are all much for muchness.
Right.
And therefore, there is no good candidate.
Yes. Well, I hope you're right. Good luck to us all. And finally,
maybe we go back to being led by our new king.
Yes. Well, it
A
can't.
monarchy.
Well, I'm willing to give it a shot. And finally, today is quadruple witching in the US. So lots of options expire. And we've featured this chart a while ago. Quadruple witching tends to be associated with big turning points in the market, positive and negative. So be warned, by the time you're watching this, it may well have passed, but okay. And on to this week's economic data. So a lot going on. So all this is from the past 10 days since our last weekly, which was on Wednesday last. So during that time, we had the ECB meeting, and the ECB raised rates by 0.75%. So the headline policy rate is now 1.25%. The deposit rate, having been negative for years, is now plus 0.75%. So that is good for banks and depositors. But all the economic data in the Eurozone continues to disappoint. The ZEW Economic Sentiment Index was forecast to fall from 54.9 in August to 56.5 in September. It fell further to 60.7. And that is very close to all-time lows. In the UK, the August unemployment figure showed that new claimants actually rose by 6,500. Now, it was forecast to keep on falling. So that is quite a big miss and may indicate that the UK is already in recession. UK average weekly earnings beat expectations, showing that inflationary pressures in the UK are persistent. The June figure was 5.2%. Forecast was that in July it would moderate to 5.1%. Instead, it rose to 5.5%. So inflationary pressures in the UK are strong. And we had UK inflation numbers, and those were reassuring. So in August, CPI dipped back below 10%, although core CPI rose to 6.3%, but that was less than expected. However, as we've seen in the US, 1 month's figures do not necessarily indicate a change in the trend. In the US, we had CPI numbers. Now, the headline CPI print actually fell from July to August. But what really spooked the market was that core CPI, i.e. stripping out food and energy inflation, actually rose strongly. So it rose from 5.9% in July to 6.3% in August. And we have quite a lot coming up on that. And the New York Fed's Empire State Manufacturing Index. Now, previously in August, we showed you that it absolutely collapsed to minus 31.3. Now, I noticed that the September print was much better. It came in at minus 1.5, beating expectations. So having reported that last month, it looks to me like the massive minus 31.3 number was erroneous. And finally, US retail sales marginally beat expectations, coming in at plus 9.1%, and shows that the US economy remains resilient currently.
Thank you, Keith. The ECB interest rate, that's a bizarre looking chart, isn't it? I never saw one. Rising sharply, steeply, and we know why, panicking. And I think the ECB has got a long way to go yet before it heads off inflation by increasing interest rates. And the EU ZEW Economic Sentiment Index is slightly below minus 50, which is a pretty low reading. And it's, I think we have very difficult economic times. A lot of manufacturing industry under huge pressure with the energy prices. UK CPI. Very shortly, there will be a line coming off that at around about 80 degrees, heading back down to 2%. I saw it in the FT 3 days ago.
Are you applying for a job at the Bank of England, Richard? Is this your pitch? For
Toilet cleaner. Yeah, so UK CPI, I mean, it's, my personal view is that we have UK core CPI, that inflation is entrenched and it's not going to go away anytime soon. It will clearly fluctuate.
Yeah, and when we see that wages in the UK are rising at 5.5%, well, inflation is going to be persistent.
Yeah. UK goods balance of trade looking really, really unhealthy. Presumably a lot of that is energy imports, but also we're struggling as a trading nation, have done for many years. UK trade balance, likewise, looking very unhealthy. The financial services sector and the services sector generally unable to counterbalance the goods import deficit. The UK claimant count, as Keith mentioned, just ticked up. So for the first time in a year, really. And the question is, are we starting to see the impact of reduced consumer confidence, increasing costs and less disposable income? It would be surprising if we didn't. So there we have a graph, the UK unemployment rate.
Well, that indicates that the UK labour market is still incredibly tight. So the unemployment rate is very low, and hence wage pressures are very high. Yeah. So it indicates to me that we need, if we're going to get inflation down, then recessionary pressures have to increase to create some slack in the labour market.
Yeah, I agree. UK average weekly earnings, including bonuses, so they are the 5.5%. Interestingly, actually, that it's not particularly high in this sequence of 12 months. US CPI and US core CPI. Interesting how that is really pointing upwards, definitively upwards at the moment. US consumer inflation expectations, what that's based upon, I do not know. Doesn't seem terribly logical to me, given the circumstances.
Actually, to me, it does, because I think the studies have shown that actually consumers their perception of inflation is mainly based on prices that they see frequently. So it's prices in the supermarket and at the pump. Right. And as gasoline prices have come back down, that has a real psychological impact on people.
Yeah.
So
that makes sense.
Yeah.
The business optimism index in the US is pretty low, actually, as low as it's been since 2014, 2013. And that is not a good sign for the economy.
Yeah, well, it's interesting. It bounced last month.
Yeah, but it's the balance is within the normal month-on-month fluctuations, isn't it, Keith?
Yeah.
And the New York Fed Empire State Manufacturing Index is not showing strength at the moment.
But a lot better than it was, as we reported last month.
Exactly. Yeah, and as you say, was that a quirk in the stats? And US initial jobless claims. Are they at a relatively stable level, you have to ask, at the moment? It hasn't changed particularly since late 2021 if you look at the absolute level now versus then.
Well, it's showing that certainly the labor market is showing no signs of recession. But as we know, the jobs are one of the last indicators to turn over. Employment lags, essentially. So lots of recessions in the 70s, employment continued to grow by up to a year after the start of the recession. And well, this really shows the labor market's still tight. So inflationary pressures are strong.
The US continuing jobless claims are pretty stable, as Keith says, not showing it as it is a lagging indicator, but there's no sign of recession in the US as far as this measure is concerned. The US 30-year mortgage rate is at a multi-year high, and the housing market, which we will come on to in a while, is being affected by this.
Yes, it ticked above 6%, doubled in a year.
Yeah. And US one-year interest rates hitting a new high with expectations that rates will go up significantly over the next few months. So US interest rate expectations for 2023 have risen by a percentage point in only 3 months, which is really significant change, given that the absolute change is more like a 30% change in view in 3 months.
So the market is no longer expecting a big cut in rates next year.
Yeah, which indicates they are beginning to expect more persistent inflation. So US inflation not showing any sign of peaking as yet, which means the Fed is likely to continue to need to raise interest rates, and Powell is speaking very hawkishly in terms of the need to raise interest rates to contain inflation in the US economy. There are elements, actually, I would say, of the US economy which are showing some signs of slowdown. The surveys, the employment result, because there's definitely not any slowdown yet, and UK inflation dipped slightly, and the economy is showing signs of slowdown. ECB raising rates despite a weakening economy.
Okay, thank you, Richard. On to one chart. Now, I thought this was very interesting. So the green line is federal tax receipts as a percentage of GDP, and the black line is the S&P 500. What it shows is that whenever tax receipts are high and go above this 18% threshold, you generally have an economic slowdown or a recession. Now, why should that be? So, first of all, the reason that tax receipts in the US are so high is because of inflation. So there's fiscal drag, i.e., the thresholds at which you start paying income tax, etc., have not changed, but we've had inflation of 10%. So you're taxing a higher proportion of people's income, and that has led to this surge in tax revenues for the government. So when the government taxes citizens, it obviously takes money out of their pockets and reduces demand. Now, if it spends that money on unproductive uses, less productive uses than private citizens would have done, that reduces growth. So that's a long-term effect. But there's also the deterrent effect of high taxes. So the tax burden for investing in a new project rises, raising the hurdle at which you are prepared to embark on new investment. And it also deters companies from hiring people and deters workers with higher tax rates from doing any additional work.
And I would say, actually, just from a personal perspective, I used to run my own company, that for a small business, it's not a very large increase in corporation tax rate could be a huge demotivator to operating that business. And you work really hard, and then you see a large chunk of your profits disappearing in corporation tax. The incentive is to not work so hard or to find a way around it and so forth. And the concept that corporation tax is sort of costless to society and the economy is fundamentally flawed. I go back to my comment about Liz Truss, and the fact that we have such a high tax economy, in my view, is really, really detrimental to economic growth in this country.
Well, I agree with you, Richard, because, I mean, frankly, I don't work, and the fact
you work very hard, Keith.
Well, I do work
very hard.
Yes,
you don't work in a traditional sense, but you do work very hard.
Right. I do work very hard, like putting this podcast together and manage my investment. But if I worked in a proper sense, i.e., being paid by somebody for my labor, I would face a marginal tax rate of 45%. I just can't, why bother?
Huge disincentive.
Yeah, exactly.
And as you say, quite rightly here, the government doesn't spend it wisely. It spends it on all sorts of bizarre administrative functions that don't need to be undertaken. And what is the problem with UK productivity? Well, possibly it's our large public sector.
Well, yeah, but they also do some essential functions, Richard, like policing and the NHS.
Yes, absolutely. They're not all unessential. I completely agree.
So first of all, beware of single factor models. But the current high tax burden in the US, if the historic relationship between the tax burdens and the economy holds, then is likely to be a drag on economic performance and is likely to indicate that the US is going to head into recession. So it is yet another indicator that is forecasting the US economy will have trouble in the coming year. And on to inflation watch, Richard.
Thanks, Keith. So in the UK, it's looking at the core CPI, and in the UK, core CPI 6.3% and increasing. Likewise, in the US, the EU 4.3% and increasing. Germany unchanged 3.2%, and Japan 2.4% and increasing. Bear in mind that Japan has never been able to create inflation over the last, is it 40 years, Keith?
Yes, actually it's 1990, isn't it? So 30 years.
Yeah. And quite right. And CPI actually slightly effectively higher, but moving in a slightly different directions in some cases. The general sense being that inflation is significant, it's not transitory or transient, and interest rates are beginning to rise to try and address these inflation rates, but note that interest rates are vastly below the rates of inflation. And if the sort of generally accepted rule that interest rates need to be a little bit above the inflation rate in order to contain it at this point, we should be looking at interest rates of 8 or 10%, which would destroy these economies.
Yes, I agree, but I think there's very little chance that would happen. I think, but at the same time, these interest rates, previously we would have considered monetary policy to be incredibly stimulative, given their real negative rates.
Yeah. So interestingly, just look at the Japanese yen. That currency in the last 6 months or so has declined by about 25%. And Japan imports a huge amount of its energy and actually imports an awful lot of raw materials. So the interest rate, the inflation rate of 2.4% in Japan, I would say is almost certain to increase dramatically over the next few months.
Yeah, we actually have sections coming up on Japanese energy imports.
So ECB inflation forecast. Oh, look, one of these graphs where the lines go off at 45, 90 degrees, Keith. Well, there we are then. We have it. Now we know what's going to happen to ECB inflation over the next few months, eh? Thank goodness. And the market's expecting continued rise in interest rates in the UK and Eurozone. Very sensibly, I think they're expecting it. I think that the unpleasant thing is going to be when this rise in interest rates hits the energy cost-induced recession, and there is a very unpleasant economic impact potentially.
Precisely, because normally when we go into recession, the central banks cut rates to support the economy. And if this is true, if these pathways play out as forecast, then we're going to have rising rates into recession. It's going to be incredibly bad for financial assets.
Yeah. And this is the graph of US month-on-month CPI, which is showing it was high, incrementally higher increase, and it's just a very unpleasant, ugly-looking chart.
Yes, I should say that this is core CPI, rose by 0.6%. So, I mean, what we saw with CPI falling and core CPI rising, as we'll show some charts in a sec, is essentially the transient elements of inflation, like energy, fell back, but wage pressure and the broad service inflation rose, and that is what's worrying the Fed.
Contribution of energy prices to CPI is what Keith has just said. So, it is a combination of factors, and food and energy. Energy dropped and food went up, and there's a lot of food price inflation in the system. I think that I suspect we haven't seen the last of.
Food commodities have actually fallen in price in recent months. But what I'd highlight in this chart, Richard, is that energy has had a negative contribution last month, but service inflation, that looks just persistent.
Yeah, and so also the US government says it's going to be replenishing its strategic oil reserve at $80 a barrel, which effectively puts a floor under the price of oil at $80 a barrel, which means that the energy price inflation is not going to continue to deflate, in fact. So that reduction in inflation will cease as soon as the oil price reaches $80 a barrel, one would guess. Yeah, and this is a rather depressing chart of core inflation with all the different ways of measuring it, but they're all doing the same thing.
So this is just gas prices at the pump in the US. And when you were talking earlier about how consumer inflation expectations were falling, then I think this is it. I think this is the reason why their inflation expectations are coming down. But
this is, isn't it? ISM manufacturing prices paid index is falling sharply, which, I mean, we have had a big fall off in pullback in commodity prices over the last few months. That is bound to be reducing input price pressure. As the note says here, also supply chain pressures have eased. So that makes sense to me.
Yeah, and if we see consumer inflation expectations falling, then hopefully that should feed through to lower wage demands, and you could see an amelioration in inflationary pressures over the coming months.
And various leading indicators are suggesting that US inflation may have peaked. And the inflation surprise index, I mean, it has ticked down slightly at the top, but it is very high. But there's a suggestion, therefore, that inflation may have peaked. And the question is, are wages stabilizing? I think it's too early to tell, actually.
Well, I completely agree, Richard. The commentary on this chart is wages are pausing, not spiraling. I think it's way too early to say that. It looks like the upwards trend is intact to me. So this chart shows that consumer inflation expectations are fading as we have reported. So long term, what's really interesting is that 3 years ahead, inflation expectations are only about 2.7%, fading back toward long-term averages, whereas the 1 year expectations remain very elevated but are coming down. So that is all good news.
In the US, so the inflation has broadened into services, continues to rise. However, the post-pandemic inflation stock, while still impacting the US economy, looks to be fading to an extent. And as long as inflation expectations don't become embedded, then inflation should begin to decline in the coming months. The Fed will need to raise rates till it produces enough slack in the labour market to reduce wage inflation, which would mean a recession. And the big question for me is, have inflation expectations actually become embedded in the labour market?
Okay, thank you, Richard. On to recession watch. So the fund manager survey is showing that over 60% of fund managers are forecasting a US recession. And historically, they have a very good track record, although obviously in April 2020, following the government mandate to close down the economy, that wasn't a difficult forecast to make. Okay, this is a really interesting chart. So Europe is facing a balance of payment shock that's equivalent to around 15% of GDP. And that is the orange bar. The other bars are balance of payment shocks in historic financial crises. So if we think about the Asia crisis of 1997, Malaysia, Korea, and Indonesia all faced a balance of payment shock of between 10 and 12%. Mexico 1994, which I did a podcast on, that was a balance of payment shock of around 12%. Russia 98 was about 16%.
What I find really interesting about this chart, Keith, apart from the comparison, is that if you look at all these countries, there are all these countries where you know they've had economic problems, they've had economic mismanagement, they're sort of quote banana, some of the banana republics, and yet the European Union is it the second largest or third largest economy in the world as a whole, after US and China.
Yeah, but it's mismanaged its energy policy.
Yeah.
It's
extraordinary.
The hard laws of economics are about to apply to Europe, and that includes the UK.
Yeah.
Okay, moving on. So this is international flights data, and I have this new website I've found called Airportia, which will report live the number of flights around the world. And this year is the purple line. And you see that it is still down on 2019. So international travel has not recovered fully from the pandemic. But what I found interesting is it started to fade. So is that indications that now that everyone's had their long-awaited summer holiday, they are cutting back on expenditure, and that is a pattern we're seeing, frankly, everywhere. Now, next week, we will do another section on the US housing market, but this week, the black line is total US homes under construction and new homes for sale, which is rising as all those new homes which have been started since the pandemic start to come onto the market, and that is happening at just the same time as sales, and that's the red line, are collapsing.
And as predicted by Portfolio Matters several months ago, I think we should add.
Yes, absolutely. And you've seen that mortgage rates have hit 6%, and that is not going to add to demand in the market. So as we've discussed many times, the housing cycle is the business cycle, and the housing cycle is turning down. Okay, and on that note, this is US household wealth, which has fallen sharply this year, mainly because of the fall in the equity markets. So the wealth effect will be negative and adding to recessionary pressures. Now, moving on to China, well, it ain't getting better. Consumer confidence dipped again last month. And if we look at data which is not from the Chinese government.
We like that.
Yes, precisely.
Proper data.
Then you find that it's all showing the Chinese economy is not doing well. So these are mobile phone shipments. And over the course of the last year, they have fallen by a third. And if we look at internal flights in China, you'll see that once again, they're collapsing. So all the indications are that the Chinese economy is not doing well. And if you look at the official statistics, it's still growing at about 5%. Well, really, is it? And consumer-facing companies are reporting a big drop in demand. So this was from earlier in the week, where Electrolux has warned that third quarter demand fell at a significantly accelerated pace. It is going to start cost cutting. That is how recessions develop. And last night, FedEx reported the same, a big drop in demand in recent weeks. And they're going to miss earnings, and their share price fell sharply last night.
Interesting. And actually, FedEx and their ilk are a contemporaneous indicator of where the economy is actually at.
Precisely. So, in summary, the US economy remains resilient as indicated by the labor market and consumer spending, but leading indicators are showing that the economy appears to be slowing down. In Europe, we may already be in a recession, and the energy crisis is likely to make the slowdown even worse, just as the ECB actually starts properly raising rates. China looks pretty terrible, frankly. Okay, on to the energy crisis watch. Richard.
Thanks, Keith. So natural gas spiked enormously in August, but it has fallen back down just as quickly. I guess was the spike around the time where Russia effectively cut off the entirety of the Nord Stream flow, Keith?
Well, it was mainly due to the drought, actually. And so, you know, France had to close down its nuclear power stations. We had a lack of hydro, etc., and also we had central air conditioning demand.
Yeah.
But I think this is going to go back up, frankly. Well, the other thing I'd say is we'll go through this in a bit, but I have done my own calculation, converting these Dutch natural gas futures prices into barrel of oil equivalent prices, and it's equivalent to $380 a barrel. So these are extraordinarily elevated numbers, even though it's down from its peak. You know, don't underestimate how expensive this is.
And also, you would expect, therefore, that because it is possible to arbitrage in the medium term, because processors that are set to use gas as an energy input can be converted to oil. They can't all be, and it can't necessarily be done very quickly, but over time it will be, which would sort of cause an equilibration of pricing to some extent, which suggests upward pressure on the oil price, oil demand, and then a little bit of downward easing on the gas price, gas demand.
Yeah, we have a chart coming up on exactly that issue, Richard, later. And I would say be very careful what you wish for, because if that happens, and Bison Interests, who produce the chart, are forecasting that actually you could have switching of up to 9 million barrels a day, which I struggle to believe. If that were to occur, diesel prices go through the roof, and diesel runs the planet. So, you would get a terrible recession. Well, we're going to get a terrible recession. It would get even worse. Okay, so in order to deal with the energy crisis this winter, the EU's plan is to have 7 new floating LNG regasification plants in operation this winter, and it plans a further 19 in the coming years. But all that is just going to add to demand for LNG. Now, liquefaction plants take years, between 6 and 8 years to construct. So the price signal this year will not have added any new supply yet. It may add new supply in coming years, but reality is that Europe is now competing with Asia for existing LNG supply. And reminder, Asia is by far the biggest importer of LNG. So if you look at the chart bottom left, you see that Asia is dark blue and Europe is green. And I should say this was from the start of the year. This is Shell. So this is before the war in Ukraine caused an enormous spike in European LNG demand. So the bottom line is, in order to get hold of those supplies, Europe is going to have to outbid Asia.
And I would just like to comment on, I'm not particularly familiar with the technicalities of regasification, but basically if you take a large ship full of liquefied gas and it arrives, you don't have any gas. You have liquefied gas, and to regasify it, you have to heat it up. And presumably these regasification plants pump seawater through to heat the gas, liquid gas up, to gasify it through some type of radiator, simplistically a radiator effect. And so to regasify a large quantity of liquid gas in a controlled manner is, I suspect, a very technically complex thing to do, and hence the time it takes to build these plants. So getting a tanker across is easy, I suspect, in comparison to the regasification.
Well, the thing is, the 7 plants that are coming online, I believe those are floating regasification plants. So those already exist. So all you then have to do is put in the infrastructure to allow the regasification, floating regasification vessel to dock and offload gas into your network. That's quite easy. Building a full regasification plant on land, that takes a lot of time.
Yeah.
So this is Chinese LNG consumption over the last 20 years, and that's your problem. It's absolutely exploded. So we will be attempting to outbid China. And this is Japan, where natural gas makes up 39% of power generation after they've closed all the nuclear power stations. I should say that this pie chart is from 2020. These are Japanese electricity prices, and they have quadrupled in a year because of the very high gas prices. Now, Japan is facing exactly the same pressures as Europe. And you've seen that essentially UK and Europe are now socializing the energy bills. So the government will be placing a cap on domestic bills, and essentially the government itself will be buying energy. Now, what happens if Japan does the same?
I'm pretty concerned about the subsidizing of energy bills. Now, I understand there's a political imperative to do so, and I understand the huge hardship that these enormously spiked energy bills can cause to particularly lower income households and the socially destabilizing effect of that. However, my fear is that once you start subsidizing the energy price, you can never stop. Because if energy prices don't drop back, and we do know that we're moving into a time where oil exploration, gas exploration has been significantly curtailed for a number of years, energy prices don't really drop back. That puts governments on the hook for subsidizing these bills forevermore, and they can't afford it. So it is a case of kicking the can down the road without addressing the fundamental problem of non-fossil fuel energy.
Yeah, well, we have a whole section coming up on the UK energy price guarantee, and I agree with you. We'll talk about this more in a bit.
Sorry, Keith, I keep preempting you.
That's all right. Well, great minds think alike, Richard. Now, thank you to our Discord member, Uncool Tom, who managed to track down a chart I was struggling to find. And this is Asian LNG imports by volume. And you see that Asia is by far the biggest market. So Europe is going to have to compete with Asia. And the problem is, and what I'm really worried, is that all the Asian markets are also in the Northern Hemisphere. And so our winters are synchronized. So their demand is going to peak at the same time as our demand. So in summary, energy prices, gas prices are currently coming down, but I'm worried what happens this winter. You know, in the UK, the temperature is starting to drop. Autumn starts next week. So the fact that prices are coming down does not mean that that's the start of a trend. I worry that they will head back up as national governments start entering the market and ensuring supply. Now, if Japan attempts to do that and other Asian markets attempt to do that, well, there's a fixed supply of LNG. So we can't all do it. Europe can't buy huge amounts of new LNG and Asia keep on consuming at its previous rate. Something has to give.
And what has to give ultimately is economic growth. In fact, not economic growth, GDP has to give.
Yeah.
Which equals recession.
So what are the investment implications of that? Well, you know, again, the UK and Europe are going to have a terrible balance of payments problem. In the UK, we are just going to have to keep on buying LNG and selling sterling. So today, sterling hit a new low. I see a spiral. As sterling falls, we just have to sell more sterling to buy the same amount of LNG. Be worried.
Yes. So, little session on the UK energy price cap. So, what is the UK energy price guarantee? So, it'll set the Ofgem price cap at 2,500 a year for 2 years from the 1st of October. And a typical household will save at least £1,000 a year. The government will fully compensate energy suppliers for the cost of the energy price guarantee, i.e. the difference between what the energy supplier pays and what they can charge the customer. And £150 of that £1,000 a year saving is going to be delivered by temporarily suspending green levies, which go towards building windmills and so forth. So in addition, there is the £400 energy bills support scheme that will be paid in 6 installments from October. And the most vulnerable UK households, see below, will also continue to receive £1,200 of support provided in instalments over the year. An additional discretionary fund will be available for those households who are outside of the schemes. So there's a lot of different elements to it. It's quite complicated. And given how many households in the country there are, the potential price is large. So the previous price cap was set at £1,971 a year, well, that's the 164.25 a month, as of the 1st of April 2022. And you will see from this chart that that is actually 60% higher than it was 9 months earlier. That's the initial huge increase that we had after Russia invaded Ukraine. So the question is, how much will the average household pay? And I should say credit to Keith for working this through. So the average household will pay £2,500 per annum, which is a couple of price cap, £208 a month. And all households will receive the Energy Bill Support Scheme payment of £400 over 6 months, so £66 a month, which will reduce their monthly payment for that 6-month period to £242 a month. The Ofgem price cap between April and October 22, as we've just seen, it's £164. So the average UK household will actually see a drop in energy bills due to the government energy price guarantee, i.e. the average energy bill will be less than the Ofgem price cap by about £22 per month.
Yes, and going back to our earlier discussion about Liz Truss, Richard, I mean, frankly, this is my point about her not being economically competent. You know, we need the gas price, the bills that consumers pay, to be high to disincentivize the use of gas. But actually, consumers are going to see their gas prices fall. So, and it's because she's introduced a new scheme without considering the effect of the old scheme, or hasn't had enough political confidence to actually cancel the old scheme when she's put in a new one. So now there are all these subsidies piling up, with the net effect that for some people at the lower end, their gas bill is going to be tiny.
I would say to that, in response to that case, I would say 1-0 to you.
Thank you, Matt.
So,
i.e. the country's lost. Yeah. Keith won, Great Britain -1.
So we also have the following one-off payments: £650 to 8 million households on means-tested benefits. It's an awful lot of households, isn't it?
Yeah.
£300 one-off payment to 8 million pensioner households who receive the winter fuel allowance, and who, I might add, this is going to sound ungrateful, are the happy recipients of a very large pension increase, courtesy of David Cameron's triple lock. Is David Cameron still around to take responsibility for his actions, or has he gone somewhere? And
yeah, exit left, pursued by an irate British public.
Yeah, and a £150 one-off payment to 6 million people who receive disability allowance. So the total cost of this lot is extraordinary. It's around about 160 billion, I think, isn't it, Keith?
Yeah, actually, I was surprised there are 6 million people on disability allowance.
Yeah,
it's 10% of the population. That's enormous.
Yeah, I know. Well, I've got a bad leg, Keith. You saw me at the weekend.
I've got a bad conscience. Does that count?
So, the government support scheme will significantly cut UK consumer energy bills, and the various schemes do not appear to have been terribly well coordinated. And the net effect is that energy bills, certainly for some people, will fall this winter, and that wasn't the intended consequence. The UK government faces potentially unlimited liability because effectively it's guaranteed, whatever the gas price is, it has guaranteed the price at which it will be supplied to us. And it is equivalent to a massive net short position on natural gas. And no details as yet on the business support scheme. Well, I did read this morning that they are going to try and put that through quickly, because they detect a degree of urgency before businesses start going bust as a consequence of this. But my concern of it is it is a huge cost, it's a huge unlimited liability, and Britain and Europe, actually, we neither can afford it.
Yeah.
And what are the unintended consequences of this action? I recognize there's a big problem, but what are the unintended consequences? And there will be a lot of them.
Yeah. Well, the main consequence for me is that we're now socializing the purchase of energy. The government is going to be buying vast quantities of gas, selling sterling. I mean, frankly, I'm very pessimistic about sterling.
And it is also a step that it's very hard to unravel this. Once it's in place, it's hard to unravel it. And can we afford 160 billion a year liability for in perpetuity? Of course we can't. So the investment implications, good for the UK economy in the short term, but fundamentally kicks the can down the road. And it's basically, its success is predicated upon gas prices dropping back to what they were this time last year. And we await the details of the business support scheme, and it will suppress, in the short term, energy inflation and therefore inflation generally. It's bad for UK interest rates because it's going to substantially increase UK government borrowing, and there is a rising gilt issuance risk. And as who was it who said that the UK gilts market is dependent upon the kindness of foreigners?
Strangers, yeah.
Strangers, yeah. If there's a buyer's strike of gilts, then we are in a real mess. And it's bad for the pound. Price cap supports domestic energy and consumption demand, which will exacerbate the trade deficit. And we will be selling pounds to buy energy throughout the winter. It's very bad for our balance of payments.
Well, I'm worried that we're facing a sort of EM-style crisis, Richard.
Yeah, I am too, Keith. And it goes back to that chart we had where with the EU having a 15% of GDP trade deficit. I mean, I don't know where we are in that, whether we're above it or below that, but it is a time of potential financial crisis.
Yeah. So what happened in, for example, the Asian crisis is just there's a sudden stop to capital flows. So, and then the country can't fund itself. And if that were to happen in the UK, then, we end up running to the IMF. And I can actually foresee that happening. Let's see.
Yeah. So, as we've discussed, we face the risk of a sterling crisis in terms of trade shock. The need to continually sell sterling to buy energy. And if sterling falls, which it is falling, and probably will continue to do so, get into this vicious spiral of having to sell more gilts to buy more foreign currency, to import energy, and the whole thing becomes unsustainable. At which point you do not want to be in sterling.
Precisely. Okay, Ukraine invasion watch. So it's been a big week in Ukraine, and the blue is areas recaptured from Russians. So in a week, they've made astonishing progress. This is in the north. This is in the south, where the progress has been slower, but they are still regaining territory. In the center, there's been a bit of a stalemate with the Russians actually claiming to have taken some territory. Okay, so when the news first occurred, there was a spike in risk assets as investors were optimistic of an end to the war and possible regime change in Russia. Now, I'm worried because for Putin, this is an existential crisis. How is he going to react? I can't see, he has no off-ramp. If he pulls out and says that the whole thing was a mistake, then surely he will be replaced as head of state. And you don't go into retirement. You end up in a hole in the ground somewhere. So I expect him to escalate if he remains in power. So what will he do? It's either universal conscription and war, or he goes nuclear. Neither of those are good outcomes. as he's got no off ramp, the only way this war ends is if he's replaced. So who's he going to be replaced by? If he's replaced by another FSB representative, then they could de-escalate the war, but Russia would remain the same. There'd be a great deal of internal repression. The only way I can see Putin leaving office and changes in Russia itself is if the army takes over. The other people who could take over is there could be a takeover by the right from the nationalists, but then you don't really, do we wish for that? You could have escalation and further internal repression and conscription. Richard, what are your thoughts?
Yeah, I think this has not gone the way Putin wanted it to go, has he? He anticipated it would be a few days lightning blitzkrieg, and his aims would have been met, and he'd now be occupying half of Ukraine with a view to taking the rest of Ukraine and moving up to the Baltic states. And that was clearly his plan. And he has found himself, he's now in a position he can't get out of. So I think the Russian economy is going to suffer increasing difficulties as a result of the sanctions. It's receiving less income for its energy, and it's highly dependent on its raw material exports. So he basically, although it's taken, I think, longer than anticipated, the economy is moving into a worse place. It's becoming worse and worse. And I think it's really, really difficult to predict what's going to happen, Keith. I can't see that conscription will solve the problem because they don't have the weaponry to fight. And they could throw vast numbers of people at it, but if they're not equipped with weapons, it's pointless exercise. That just result in more deaths and no territory gained. He may sue for peace. I don't know what the view of, this isn't a NATO conflict, but I don't know what the view of NATO would be to him suing for peace. He is trying to ingratiate himself with the Chinese, and I think the Chinese are backing away from him because they don't back losers, and he's clearly a loser. I think it's very difficult to know how it will happen. I mean, the one thing we don't want is nuclear. The one thing that might solve his problems is nuclear.
Yeah, I know. Worrying, isn't it?
Yeah.
Okay, thank you, Richard. On to QT. Now, this is interesting because the Fed is selling down its holdings of US Treasury. And there are good reasons to think that QT leads to problems in the Treasury market. There was a paper out a while ago by Raghunathan Rajan, the Indian bank governor, who talked about how QE affects the financial system. And so QE pumps the banks full of cash. So banks have more deposits and they issue lots of lines of credit to corporates. So the corporates have guaranteed ability to borrow money from the banks for a period of time. Now, when you have QT, the banks don't cancel those lines of credit, which are legal. So instead, what they do is they hand cash back to the Fed. So when there's then a period of stress, corporate borrowers all start drawing on their lines of credit, pulling money out of the banks who don't have much cash because they've handed it to the Fed. So then you have a liquidity crunch. And in that liquidity crunch, the banks try and sell their holdings of treasuries for cash, but they are the natural market makers in the treasury market. And what you get is a total failure in the treasury market. Now, this has happened twice before when there was QT. So there's the repo crisis in 2019. And early in the pandemic, there was a total failure of the US Treasury market. Now, I remember that very clearly, and we talked about it previously on this podcast because I had a holding in the iShares US Treasury ETF. And my holding was, tiny in comparison to total liquidity. This should be the most liquid market in the world. And for 2 days, I couldn't get a bid. It was absolutely extraordinary. So as we have more QT, are we going to face problems in the Treasury market? Now, when that has happened previously, the Fed has essentially had to capitulate on QT and return to QE to provide liquidity to the Treasury market. Will that happen again? Now, the other thing I'd say, sorry, Richard, before you come in, is that in 2020, yields didn't really rise. What happened when I was trying to sell my tiny iShares ETF was you just couldn't get a bid. Prices didn't move that much, but liquidity disappeared. Richard.
Yeah, it's very interesting, Keith. And that chart showing the liquidity conditions is very interesting. My view is that QT is going to be transitory and that QE will be initiated relatively soon. I think Europe will initiate QE because of the energy crisis. The UK will have to initiate QE because of the energy crisis. And the US will have to initiate it because of the bond crisis. And I don't see that there's going to be any option other than that, and effectively further debasement of the currencies. And they will all debase together, with the US still being the strongest.
Okay, and on to investing in an inflationary environment. Now, US rate expectations are still rising and have risen sharply over the last month, particularly in the last week when we've had this surprisingly strong CPI print. Now, what is interesting is if you look at previous economic cycles, then the 10-year tends to peak at around the same time or slightly in advance of the peak in federal funds rates. So the peak in the 10-year bond yield is between 4 months and 0 months ahead of the last Fed interest rate rise. And this is the chart showing in the red line the 10-year yield and the blue line the Fed fund rate. In timing the bond market, you want to be looking about 4 months ahead of where you think the peak in the Fed funds rate is going to be. But if we look at what happened in the 70s and 80s, you'll see that yields only really fall if the market believes that inflation won't return. So if we look at 1979, which is the yellow line, yes, there was a peak, but bonds really didn't fall very much before rising again very quickly as inflation proved persistent. You see, look at 1978, the green line, the same is true. Bond yields only fall like they did in 1980 if the market thinks that inflation is now properly under control. And that makes investing in bonds potentially dangerous. Bond yields will only fall if the market believes the Fed has done enough to bring inflation under control permanently. This is very important because asset yields follow interest rates. And this makes so much sense, essentially. The yields on equities will tend to peak with the yields on bonds. So you don't want to be investing in equities either until at least the peak in bonds. But now I saw this chart. What it purports to show is that if you buy equities when inflation peaks, this always leads to good returns for equities. So they're saying buy when inflation peaks. But if you're interested, pause and examine this chart closely, because that may be true in the medium term. But if you look at the bottom chart, and the purple line is the annual percentage change over the subsequent year for the S&P 500. And the dotted lines are the peak in inflation. And you'll see that in a lot of cases, most notably recently, both 2000 and GFC, the returns after the peak in inflation were negative for years. And so what I'd say is the peak in inflation may mark the beginning of the end of the bear market. It does not mark the start of a bull market. And if you look at returns of the S&P 500 around the peak in inflation, averaged around all the economic cycles since the end of World War II, you'll see that prior to the peak in inflation, the S&P 500 tends to return around -5% in the preceding year. After the peak, it returns +17 on average. But I should emphasize, on average. You see that there's huge variation. In some cases, you've had returns of -40%. So volatile, be careful. And if we look at what happened in the early 80s when Volcker raised interest rates very high to bring inflation under control. So the dark green line is US 10-year yields. The light green line is CPI. And the blue line is the S&P. And you'll see the S&P was volatile until 10-year yields made a convincing turn downwards. So it was only when the market really believed that inflation was actually properly under control that equities took off. And I think that has lessons for the current environment. So, frankly, I wish I'd known this previously. And it is obvious. So regular viewers will know that I have a decently sized position in US long bonds, and I've been too early. I thought, to be fair, I thought that inflation was close to peak, and it's clear if the peak in inflation will be some way off, and I have been too early.
I was going to say, Keith, you did invest in the US long bonds for another reason, which you got absolutely spot on, which was you were very wary of sterling.
Yes, that's true. But I mean, I've been right on sterling and then lost all my gains on as long bonds come off. Yeah. So don't invest in bonds until the peak of inflation is in sight. Don't invest in equities until the peak in government bonds is in sight, plus the bottom of a recession. So that's crucial information. The chart we showed was saying that you should buy when inflation's peaked, but actually you should wait further until the bottom of a recession is also in sight. But as always, no single factor model is entirely reliable.
One of the things that we could say, well, we talked about particularly there, Keith, but just generally, there's an awful lot of volatility. Yes. And there's no rush to do anything, I think.
That is extremely sound advice, Richard. And in retrospect, I was impatient in moving into bonds too early. I should have just sat on my hands. Patience is actually one of these key skills of an investor, just being able to sit around and do nothing.
Yeah.
Wait for the right time.
Okay, so we're going to move on to some other charts now. And the first other chart is the global primary energy consumption by type. So as a percentage, so we have crude oil is at 30%, coal at 27%, natural gas 24%. So fossil fuels making up 85%, roughly speaking, of the total. And then a little bit of hydro, a little bit of renewables, and a little bit of nuclear. The point being the energy transition away from fossil fuels is going very, very slowly and has a huge way to go. In fact, how do you think about how long does it take to build a hydro plant and how many can be built? Because obviously they're very geographically dependent. Well, a long time. How long does it take to build a nuclear power station? A number of years. How long does it take to build a windmill? Not nearly as long, but it's generating its nameplate capacity is, at 1 megawatt, for example. In reality, it only produces about a third of that because of the wind.
So we're going to be dependent on fossil fuels for a very long time at this rate.
And so the UK has issued a lot of inflation protected government debt, which is great, actually, if you're an investor in it in inflationary times. But if you're the UK government, it's a real nuisance because, of course, the interest rate you have to pay on it is linked to inflation. 3%. Oh, the UK linker bill could reach as much as 3% of GDP next year if inflation forecasts are realised. Well, that's extraordinary, isn't it? That's roughly 30 billion pounds.
We talk a lot about how governments can inflate away the debt. Well, they can't if they've issued a lot of inflation-linked debt. So the UK has, and as inflation rises, so actually government finances are going to get worse.
So Credit Suisse CDSs, credit default swaps, close to 2008 levels. Basically, what this means is you invest in a company, you buy their debt, you can buy insurance against and go bust, and that's the credit default swap. And it's like paying for insurance. The greater the risk, the higher the price. So Credit Suisse, the price of these things has more than doubled in the last few months, which indicates the market is very, very wary of corporate debt.
Yeah, in the Eurozone, you can see that, the energy crisis is going to lead to a lot of stress on companies. We're seeing some of them go bust already. That always ends up in the financial system. I'd also say that all these banks are full to the gunnels of government bonds, which are selling off. And if we have a Eurozone crisis, kaboom.
We've talked about this before. This is the Target 2 system, where basically Germany finances the rest of Europe to buy their goods. So there's the good goes from Germany to, for the sake of argument, Italy. Italians buy it, they buy it on credit. Where's the credit come from? It comes from Germany. So they're effectively, Germans are selling goods on, an expression my mother used to use, selling it on tick. And what that means is that the current Target 2 liability, which was enormous back in the January 15, current Target 2 liability is 1.2 trillion euros, and that is a massive liability. I don't know what the German GDP is, but let's say it's 2 trillion. For the sake of argument, that would make it. It's enormous.
Yeah,
and it's unpayable.
Yeah, they can pay the interest.
It would be repayable with QE, but without QE and preferential QE to the creditor nations.
I suspect it will be repaid in lira, mate.
Yes. Most UK mortgages are fixed between 2 and 5 years. When these are refinanced, homeowners will see a huge jump in their repayments. They will. But the other point is there is a counterparty to these fixes. And if you fixed at 1% a year ago for 5 years, someone is paying the differential now. And that someone did not bank on it when they issued the fix. and there's a huge amount of these things out there.
Yeah.
So I think there's a counterparty risk in this system as well. So apparently, these are derivatives, yeah. The credit default swaps are derivatives. Apparently, there's 5 quadrillion of derivatives in the world, and the theory goes that they're all matched because they're all, you issue a derivative, you have one person has an asset, one person has a liability. Of course, it doesn't work that way, does it? Lehman being the case in point. So there's 5 quadrillion. World GDPs, I don't know, 70, 80 billion, or trillion even. So there's like, what, 50 times global GDP of derivatives out there? When that lot goes tits up.
Yeah. Well, we talked about this previously, Richard. I think you're absolutely right. Whenever we have a spike in interest rates, then people who are over leveraged go bust. And that's happened every other time. I'm just waiting for this current cycle to reveal who's over leveraged, and we'll go, we'll morph into a financial crisis. And actually, when we're talking about derivatives, essentially, the UK government has just shorted the natural gas market.
Yeah. Very wisely as well.
You want to do this?
Yeah, so looking at equity markets, I'm just going to run through the year-to-date change. I think that's the most interesting one. So the FTSE All Shares down 5.4%, Stocks Europe down 16%. And I think recently the Stocks Europe, to me, appears to have started to react to the dire energy situation in a more, what I would call a more rational way than it has. The S&P down 18%, and NASDAQ has reinitiated its drop and is now down 26%. I'm expecting it to drop by 60%, at least before this is all over. Hang Seng 20%. Topics, bizarrely, almost unchanged, but presumably that's because of Japanese government intervention.
I think that's due to, they've got a lot of companies that earn foreign exchange, and the yen has collapsed.
Yeah. Good point, Keith. Bitcoin down 6% year to date. The pound down 15% year to date. Not good, is it? The pound in your pocket is depreciating rapidly. If you want to go on a foreign holiday, I'd go now. And the euro is down 12%, almost as bad as the pound. The dollar index is up 15%, which, considering that the dollar index is basically the Japanese yen, the GBP, and the euro, it's not surprising that that's where it is. The US does not want the dollar index to go much higher because it damages its own economy. And there we have the S&P, quite volatile. The dollar index, I look at it, you can draw some trend lines through there, can't you? And it's bang in the middle of its uptrend. So the US stock market just had its worst day since 2020, presumably the COVID move. And if you can interpret this chart, you're a better person than I am.
Okay, well, so the dots are all the market moves in that year. And you see that this dot far left here is the worst daily move during 2020, was minus 12%. And this week's minus 4.3% stands out as the worst in 2 years.
It looks like the cross-section of an elliptical galaxy to me, Keith, 2022. So fund managers are pessimistic about corporate earnings, and this is percentage of fund managers who FMS investors say global profits will improve, and basically, they're not, and they are predicting global recession in essence. But of course, they're forecasting strong earnings growth in 2023, as they always do.
Yeah. So analysts have just not revised down their forecasts yet. I mean, if you look at this, intra-year, they're saying that 2023, their earnings have come down, but they're still forecasting 10% earnings growth. No, I think they're going to be disabused of that.
I think they are, unless they're talking about windmill companies. So when you think the bear market is over, you need to buy, as we were discussing earlier. And you don't want to hold on to cash because, as we know, cash is a declining asset with inflation. We need to be careful about when we buy in bear markets, obviously, because as Keith discussed earlier, there's a lot of volatility there. But this is a chart that shows what the 12-month performance has been historically after a greater than 20% decline in the market. So you could see that the 12-month performance has been generally at least a 20% gain.
Yes. In fact, universally, a 20% gain. And they're saying, essentially, you should buy now. I noticed, though, Richard, that they haven't included the Great Depression because it wouldn't have worked. It would have been awful.
And I think, you have to, I would say you have to understand the cause of the bear market and understand whether the cause of the bear market has been removed, and pessimism is just a hangover. And Keith and I don't think that the cause of the bear market has in any way been removed as yet.
Yeah. Patience. Sit on your hands.
Yeah. The S&P earnings per share versus trend. And is it sustainable that earnings per share should be so far above trend? No, it's not. And this comes back to our analysts' expectations. They should be factoring something like a 30% decline, not a 10% increase. Just to take it back to trend, I hasten to add.
Yeah. Robin Brooks on Twitter has laid out some reasons for why he expects the US dollar to fall. As you've seen earlier, the US dollar index has had an amazing run. And he's saying that as we reach the peak in US policy rates, then so the dollar should start falling. But I'd say, what are you going to hold this winter? What are the alternatives?
Yeah, I agree, Keith. And I would say that the economic conditions between the US and Britain and Europe are massively different because the US is not suffering this huge energy spike in the way that we are. And the problems that we've been talking about in Britain and Europe this winter are the massive sums of money that are going to have to be spent on importing energy, which the US does not have to do, and the effect on the balance of payments and the currency there. And that is why, in my view, the pound and the euro will continue to weaken against the dollar.
Yeah, completely agree.
And if we put interest rates up to try and stop it, we'll crucify the economy.
Yeah.
The 12-month inflow into US bonds and cash in trillions. It shows that safe haven flows into the US dollar have been huge.
And that's why the dollar's been so strong. And until you see an end to that, dollar's just going to keep on rising.
Yeah. And Keith actually is responsible for about half of that.
I wish in my dreams one day when, portfolio, when we have instigated subscriptions for PM at, $2,000 a time.
I didn't know we had so many subscribers, Keith.
We don't.
So this chart suggested that currencies are very difficult to value at the moment. The euro US dollar is cheap on a CPI basis, but overvalued on a PPI basis. Well, I think we've discussed why we think what we think is affecting the euro and the US dollar rate at the moment, and it's not really PPI or CPI, it's the energy crisis. And as we saw earlier, Europe's balance of payments has collapsed, and that's very bad news for the euro currency and very bad news for European inflation and the European economy.
And I'd also add, Richard, this is going to get worse because essentially Europe is a huge exporter of machinery and goods. As the world goes into recession, those are going to fall, but it's going to keep on buying energy, which is why there's a current trade deficit. So in contrast to what Robin Brooks is saying about the dollar peaking, I just think that euro and sterling are in big trouble.
I agree. Sadly, I agree with you, Keith.
Okay, so silly but frightening chart of the week is This is an analogy between the great financial crisis and the current bear market, and we are on track. You can
So
draw
50%,
yeah.
50% decline from here. Is that what you're suggesting, Keith?
And today is the anniversary of Lehman Brothers going bust.
Oh, is it?
Yeah. Be afraid. The thing is, you can always, somebody on Twitter is always drawing a chart like this. There's so many, every bear market in history, you can kind of align with the current bear market. Yeah. But anyway.
Think how they'll be aligning with this bear market in the future.
Well, yeah.
It's not as bad as the 2022, they'll say.
Yeah, exactly. Will anyone be around to see it? So thank you, Richard. On to commodities and energy commodities. And all these figures, I should say, are over the last 10 days since we last did Portfolio Matters on Wednesday. So over that time, Brent and WTI oil futures have been flat. Dutch natural gas futures have come off, as have UK futures, settling from extremely elevated levels that it's barely plausible anyone can afford to very, very expensive levels. American natural gas futures rose slightly. Coal settled, but is still up 163% on the year. Uranium fell slightly.
And can I just chip in there, Keith, very briefly to say, look at the differential between US natural gas and TTF natural gas. And this is why I think that the US dollar is going to remain strong.
Yeah, I completely agree. Although, obviously, they're all priced in different bases, which makes it a pain. You can't just look at the two numbers, but it is nonetheless true. Okay, on to some data specific to the oil market. And over the last 2 weeks, we have seen a net rise in total US oil inventories, although not by very much. When you exclude the SPR, private sector inventories have actually risen by 17 million barrels over the last 2 weeks. But essentially, that means we've drawn 17 million barrels out of the SPR. Can't continue forever. But inventories in the US are showing that the market over the last 2 weeks was adequately supplied. Now, US oil production has been hugely disappointing. Despite a huge rise in the oil price, there's been barely any supply response. So since the start of the year, and we're now in September, we've added only 300,000 barrels a day. We have more on that coming up. The Baker Hughes rig count has continued to fall. It's now down from its peak and lost another 5 rigs last 2 weeks. Okay, and while we talk about the failure of the US to add supply, let's talk about US shale. Okay, so the pink line is the rig count, and you'll see actually it's been coming off for the last month or so. And if we look at fracking crews, well, we really haven't added many over the course of the entire year. So the US is failing in its role as the marginal supplier. Now, if you look at productivity per well in the US shale patch, well, it's peaked. Shale basins becoming less productive. And during the week, there was this from Shubham Garg on Twitter, and he was reporting the results of 15 new wells drilled by Pioneer Resources in the Midland. And what is interesting is that these wells were much less productive than their historic wells. If you look at their average well, so the dark blue line is 2022, the light orange line is 2019. And so the productivity of the wells has been declining since 2019. And is now down 23%. So productivity per well has dropped substantially, and it's worse than that because they've been drilling longer laterals. So the wells have been bigger. And if you adjust for the lateral length, then productivity drops by 30%. So in the Permian, there certainly is still capacity, but we have drilled out an awful lot of the shale patch. And just look at this chart and concentrate not on the number of wells drilled, but how much of the area has already been drilled. So going forwards, shale wells appear to be becoming less productive, which means that you need to drill more of them to get the same amount out, which means that the cost is rising. Your break-even price is rising. And so it seems to me that having not invested in oil for a decade now, we're going to have trouble growing or even keeping up with current production. So medium term, I remain very bullish about the oil price. So this is crude, and short term, if the US goes into recession, remember that crude oil price curve is extremely inelastic. So small changes in demand lead to big swings in the price. And as the world goes into recession, so the demand for oil falls, and historically that has always led to a collapse in the oil price. Now, Richard is saying that the SPR will start buying at $80. So perhaps there's a flaw there. Okay, so this is Chinese oil demand. Look at 2022, 0. Now, is that due to COVID lockdowns, or is that just the fact that their economy is doing incredibly badly? Now, obviously, oil bulls are saying that it's due to the fact that COVID restrictions have artificially closed down the economy. When those end, it'll bounce back bullish for oil. The thing is, they're not ending. And actually, the Chinese economy is doing very badly. So not necessarily bullish, frankly. Now, HFI research are forecasting that the oil market will remain in deficit in the coming years. Now, I agree if we stay out of recession, but we're not going to stay out of recession. So, but as soon as the economy recovers, we go straight back into oil crisis. And this is global private oil inventories. And this year is at the bottom. And actually, they're not shrinking. Now, I realize that the world is being subsidized by releases from the SPR, about 1 million a day. But overall, the oil market is not significantly out of balance. And if we go into recession, you could see the balance going strongly positive. So more supply than is needed. But what we certainly lack is refining capacity, because we put sanctions on Russia, who are a big supplier of diesel. So the crack spread is enormously positive. Reminder, the crack spread is the price of products minus the price of oil. So it's how much refiners are making, and refiners are minting it. Okay, now I talked about this chart earlier, and this is from Bison Interests, and it shows the capacity for gas to oil switching. So how much oil could be consumed instead of gas. And in total, they're talking about almost 9 million barrels a day. Now, frankly, I just don't believe this, because if we look at the price of European gas in barrel of oil equivalent, the current EU gas price, this is as of yesterday, is equivalent to $387 a barrel. So if you possibly can burn oil products instead of gas, you would be. Hence, I don't believe there's this spare capacity. Richard?
It's very difficult to tell, isn't it, Keith? Because one of the key questions here is how quickly can you switch and what is the cost of switching? And we don't know that. And presumably, for technical reasons, it can be very varied from being as simple as switching a burner over to having to fundamentally change your production processes. And there is, if you're running one of these things, you have to take a view, don't you? Do you invest capital to switch and find that you shouldn't have invested your capital because the prices of gas got back down to a point where your switch the capital you spent on your switch was wasted money. And I think that this, whilst it's interesting to see in terms of how, if you were to plot a realistic time frame of how long it might take to do this switching and under how long the current pricing disparity would have to persist, I think it's really complicated. What we probably can say is there is switching going on, and it'll be the low-hanging fruit. But how much of it is the low-hanging fruit? I don't know. It's tricky to know, isn't it?
The thing is, I took this to mean, when it says switching capacity, I took that to mean capacity to burn oil right now, as opposed to we need to close down the power station to rejig it, which will take 3 months.
So I suspect, Keith, and I don't know, I suspect it's not that, because I can't think of any gas burner where you could simply turn the gas burner into an oil burner.
Okay.
I mean, there may be some where they're set up for dual usage, but generally speaking, if you're operating an industrial plant, it's either set up for gas or oil, but not both. Well,
in which case, is an open question about how much capacity there actually is. And my point is that if you could burn, gasoline or diesel right now, you would be doing so because it's a quarter of the price of gas.
I think that's right. And we can't. I mean, you can't switch your diesel vehicle to a gas vehicle, can you? And you can't switch your gas-fired power station to a diesel-fired power station or oil-fired power station. So it's a tricky one. But clearly, at the moment there's a big financial incentive to switch if you can.
Yeah, absolutely. And I take your point that the longer this persists, the more the people will actually start doing the investment to switch to burning heating oil. Okay, on to European natural gas futures, and they have come off to extremely elevated levels. Now, 85 LNG shipments are currently on their way to Europe from around the world. And if you look at how Europe's energy mix has changed over the last year, so the left-hand side of each box is the energy mix in 2021, and the right-hand side is the energy mix over the first half of the year. And you'll see that everyone has reduced their reliance on Russian gas, mainly in favor of LNG.
I mean, one of the longer-term consequences of this for Russia is that it has screwed its energy export market.
Up to a point. If it cuts the price, if we get a political settlement and it cuts the price, then, and European LNG imports are rising. But actually, what I found surprising about this was it's not hugely increased from last year. I would have expected it to be, double or treble, but it's not.
Well, one of the issues, of course, Keith, is the regasification.
Yeah.
And it's interesting that 85 ships, but what was it this time last year, I wonder?
And these are UK natural gas futures. Again, down, but still double what they were just a few months ago, actually. US natural gas futures Now, when we talk about the growth in LNG exports, then in the long term, the market is expecting most of the growth to come from the US. But you'll see that we're now reaching a point where a lot of the existing projects have come online or about to come online, and there is then a hiatus before the plants under construction come online. So we're not going to see much LNG growth from the US in 2023. Well, I thought this was interesting. 30% of new ships are LNG fueled. So that's an added demand. And this is from the start of the year and from Shell, and shows that even before the Russian invasion of Ukraine, essentially demand was forecast to outstrip supply. So the LNG market is going to be tight for years to come. This is coal. Frankly, that line just looks straight up. The trend is very much intact. And one of the reasons that coal's been doing so well is that we've had low rainfall in China, which means low hydroelectricity, which means they're burning a lot of coal. And this is uranium. And Katusha Research, you'll like this, Richard, are bullish again. So they're saying there's going to be a big shortfall in uranium production as everyone starts restarting or investing in new nuclear plants, particularly Japan reopening their existing plants, which were mothballed after Fukushima. I've heard it all before, sadly, but I thought this was an amazing chart. Okay, so this is the energy density of various substances. So lithium-ion battery is 1. Oil is 42. Coal is 32. Wood is 12. Uranium is 79,390,000. So, you know, essentially the answer to our energy problems is nuclear. It's obvious, you know.
It's been obvious for a long time, Keith.
It has, yes.
So I'm just going to run down the year-to-date change again, and we can see actually, generally speaking, there's been significant pullbacks in the year-to-date. So aluminium's down 18%, cobalt 26%, copper down 21%, chromium up a little bit, iron ore down 10%, lithium up a lot, 80%, neodymium down 26%. Nickel actually had that enormous spike, as we know, the short squeeze, but up 10% on the year. Tin, which I remember last year talking about the never-ending upward incline of the tin chart, is now down 45%. Ferrovanadium down 4%, 5%, and zinc down 9%. So generally speaking, industrial commodities have had a poor year to date.
After a very strong start to the year, it's completely reversed.
Yes. Yeah. So aluminium, cobalt, copper, chromium, iron ore, lithium, which has leveled off since March.
Not coming down though, unlike all the other commodities.
Yeah, definitely. Neodymium, and there's nickel, tin, ferrovanadium, and zinc. All the precious metal, gold is all the precious monetary metals, gold, silver, possibly platinum, not really, down significantly year to date, and they, which is sort of surprising given the inflationary environment. Palladium and rhodium, palladium up 10%, rhodium unchanged, platinum down 7%. They have various industrial uses, as we know. Personally, I'm still sticking with gold. and silver as a hedge against the currency problems that we have. And I just think their day will come.
I agree with you. Their day will come, but I think it's not quite yet, Richard.
Will I still be alive when their day comes? That's the question. Or will my grandchildren benefit? Which I don't have any of yet, by the way. There we have gold.
Bad week.
Yes, definitely bad week. Gold versus 10-year real yields. So gold is holding its own versus 10-year real yields at the moment, but as the commentary says here, if it catches up with the real yields, it will fall. I mean, this is a chart that shows a correlation, but whether the correlation remains, who knows? And likewise, it's also similar. This is actually a shorter term correlation of just over 3 years. And there has been there was a correlation on the way up, yes, and across probably to Q2.
Yeah, but it would make sense. I mean, it's cost of holding gold, isn't it?
Silver, platinum, rhodium, and palladium, which is showing a little bit of life, really, of all of them.
Well, of course, Russia is a big producer of palladium, so
yeah,
that's supply difficulties.
Yeah.
Okay, thank you, Richard. On to rates. So next week we have the Fed. So they're expected to raise rates by between 0.75 and 1%. But this week we had continued rises across most of the curve in the UK and in the periphery of Europe as well. So taking through a few charts. Now, first of all, actually, before we get into it, regular viewers will know I've moved all of my sterling cash into US dollars, and I was unable to find an iShares ETF that was just cash. So I've been using the 1 to 3 year Treasury bond ETF. Now, one of our viewers and now Discord member, Bear Trap, has found a much better ETF. And I wish I'd done further research and found this myself. And so this is the Lixor Fed Funds US dollar cash ETF. This is the performance. And the thing is, it has performed much better than the iShares 1 to 3 year Treasury ETF, because, of course, treasuries, short-term treasuries, will fall as rates rise, and they have done so. So this is the performance over the last couple of years, and FEDG has performed better. So if you are thinking of moving your sterling into US dollars, then this is an instrument you should consider. Thank you very much to Bear Trap for sending us this. The one thing I'd say is that the iShares instrument is enormous and hugely liquid. I noticed the market cap of this one was quite small, only about 50 million, but the quotes had a very small spread, so it seems to be pretty liquid. Okay, so this is bond yields compared to dividend yields, and you'll see now bond yields are significantly higher than dividend yields. So does that mean that actually bonds are a better buy than equities? Well, when you consider the outlook for earnings and actually whether those dividends are sustainable, then I think it probably does. US break-even inflation rates appear to have peaked. Now, I thought this was also interesting. You would expect investors to demand a higher yield, a higher risk premium to hold bonds in highly indebted countries. And that's true. So as government indebtedness around the world rises, you might expect investors to demand higher yields. And all that means that government solvency becomes a problem. There's more debt and the yield on it is higher. So Italy, that's a real problem. And when we look at the performance of bonds, well, September was awful. Had a sharp sell-off in bonds of all kinds. And it's been an absolutely terrible year. So if you look at the 25-year bond ETF, it's fallen 46% from its peak, compared to only 13% for the S&P 500. Admittedly, this is chart's a few days old now. And bond volatility is very high. So currently, bonds are proving a terrible asset, both volatile and deeply negative. And this is the UK 10-year gilt. The yield has continued to rise. The late summer has been terrible. This is the 30-year, also terrible. US 10-year yield is steadily rising. And frankly, looking at that chart, no sign of a peak. And going back to our earlier conversation about investing in bonds and equities only when bond yields have peaked, well, that time ain't yet. This German 10-year is trending steadily higher. Italian 10-year. Reminder, if Italian bond yields stay at these levels, the Italian government is insolvent. Greek 10-year. Finally, the seasonality chart, and we're heading into a difficult period. So concluding comments, well, simply this. Asset prices face a combination of rising yields and slowing growth. And that is not a happy combination for equities. So we are potentially in for a very difficult winter, and autumn starts next weekend. Richard, what have you been up to this week?
Thank you, Keith. So I haven't presented one of these for some time, had a very sort of nice, relaxing summer break, and it's good to be back. So this is basically the change for the year is up 0.7% effectively, no change for the year. The FTSE All Share down 5.4, so relative performance 6.1, but I'm not very pleased with my absolute performance of only 0.7. So what have I done over the summer? I have actually bought into some uranium miners, and I've done it via Encore Energy, a small uranium miner called Sky Harbor, and then what's easily available in the UK is the Geiger Counter Investment Trust. And I view these as sort of a holding for a couple of years. My only concern is that nuclear power stations have to be built by governments, and if there is a government funding crisis that damages the ability of them to fund the building of new nuclear power stations, then that clearly would affect the uranium market. On the other hand, one could see very little alternative to building nuclear power stations in order to keep the lights on and stop GDP from plummeting. So that's what I've done. And this is my portfolio balance. So still mostly in cash and precious metals, a little bit in gold miners, silver miners. The amount in uranium has increased. I've got a little bit of lithium, a little bit of rare earths, and a little bit of oil. In fact, it's diversified energy. It's not oil, it's gas. So and that is me. I am probably going to stick pretty much as I am now. I was intrigued by the ETF that Keith identified for the cash deposit in US dollars, and I don't like the way the pound is going, and I do think it's got quite a long way further to go. I think deposits in sterling are very vulnerable. I do have some of those still, so I will look to moving a bit more of that into the US dollar one way or another. How about you, Keith? What have you been up to this summer?
Thank you, Richard. Well, over the last week and a half, sterling had a brief rally, which it has had since reversed, but yields have risen and I've lost 0.3%. The all share was up 0.2% over that time, so I've underperformed, but I'm having a good year. had no buys, no sales. Thank you very much to Bear Trap for having sent me that details of the Lixer US cash ETF, and I'm frankly annoyed that because I bought the short-term bond ETF because essentially I thought it was a cash proxy, and obviously yields have risen, and although I've got the call on sterling absolutely right, I've been too early on bonds, as has become obvious to me while putting together this week's presentation. And so my losses in long bonds and actually the short-term bonds have offset my gains in sterling. So it's been rather a frustrating time. So I have the vast majority of my assets in US dollars in a mixture of short and long-term bonds. I hold very few equities. I hold DEC, Diversified Energy, is my main holding, and that is natural gas and hedged. So I continue to hold that for the dividends. I also hold Gold Plat, and then I hold RS Strategic, which has been an absolutely terrible investment, but my original analysis still holds. And as it gets closer to having its floor spar projects in operation, I think that it should realize some value, but so far it's been awful. Now, we had some corporate updates this week, and I'm afraid it's all bad news. Now, Rambler had an absolutely terrible week. So Rambler this week issued an RNS in which it talked about having a weak balance sheet and needing to fix that balance sheet through either a placing, so equity raise, or horror of horrors, a debt for equity swap. Now, if there's a debt for equity swap, shareholders are really going to suffer. And what I thought was absolutely terrible about this RNS was it didn't provide any details of the problems or of the solutions. So it just created a whole load of uncertainty and massacred the share price. I thought it was an object example in how not to do corporate communication. Terrible.
They basically said they needed money and they'd let the market know how they were going to raise it.
Yeah.
Which is like as good as saying we're bust unless we can raise some money.
Yeah. What you should do is try and fix these behind the scenes and then announce what you're going to do, or at least have a plan. Say what you tend to raise equity, or you're in discussions with bondholders or something. Contain no details. The other thing I'd say is that when we go into this period of a bear market and recession and rising interest rates, where investors have lost money, markets are down, companies that need to raise money are going to find it very difficult to do so. And so if you have companies with weak balance sheets, then Rambler should be a warning sign. This could happen to those companies as well. So be very wary. And we've previously discussed, my approach is very much, I play the cycle, I get in, I get out. And other investors, have strategies, long-term hold, but nobody gives you a medal for taking losses, frankly. And in cases like Rambler, really, I got out in March because I foresaw that we're going into recession, which would mean lower copper prices and a combination of higher oil prices and energy prices. And Rambler is a high cost producer, and I saw that was going to crush margins, and that is largely what's happened. So I really think that you need to play the cycle in commodities. Now, Ferroalloy Resources also did a fundraise, but they're raising 8 million at 12p. And so share price fell, but it fell to 12p. And their project, the feasibility study gets announced next year. In the meantime, we are in the mining development cycle, which I've shown you that chart many times. essentially share price isn't really going to go anywhere until things start happening. So in the long term, I still think that the Valor Source Candic project is a very good one, and I will be looking to buy back in. But the share prices of these junior miners tend to get very badly hit during recession, and I think I'll buy it at an even better price over the next year. Anglo-Asian mining, unfortunately, has all its assets in Azerbaijan, and they've just started fighting Armenia. You'll remember that a lot of their projects they got back from Armenia. Well, and loads of uncertainty. They haven't had a good run. You know, we wish holders good luck, but you know, more fighting could be very bad. And Jadestone Energy, well, Montara, is going to be offline for longer because the regulator has basically told them they need to have everything certified, their fixes certified, etc. So, okay, that is it. A long one today. We are hopefully back to the usual schedule for a few weeks. Yep. So we are now heading into winter. Good luck to everyone. In the meantime, thank you for watching. Please can you press like and subscribe to the channel. And it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.